Good afternoon or good morning, good evening, depending on where you are, and welcome to ESGX Live, the community for information and education, most importantly to inspire collaboration and action. And I'm coming to you from New York, where we are in the midst of New York's Climate Week and the UN General Assembly, and with Paul Herman from France and Amir Khaleghi from somewhere in the US. I confess I'm not sure where he is right now. Just as a very brief introduction to the Green Jobs Show, that this is a series we've been running now for 2.5 years, and there is all sorts of data that has been gathered over time, and I'm really interested to see what we have what has emerged over the last couple of months during what has been the summer break for us, perhaps a winter break for those in the Southern Hemisphere. If you are watching online, please do like this, say hello to each other in the chat, share it with your friends. Every time you hit the like button on YouTube, more people watch the recording and we get the messages out. On a personal note, one of the highlights for me this week has been the launch of Earth for All, a project I know we've talked about and a book I know we've talked about over the last couple of years. The German language translation was released first about 2 weeks ago and is number 4 bestseller in Germany in the non-fiction list, which is really quite fantastic. So huge congratulations to the 149 people who are mentioned in the credits as having contributed significantly at the beginning of this book, and hundreds more beyond. That book went on sale today, so it is available from all good bookshops, online bookshops, etc. And it talks about the 5 turnarounds we need to see if we are to avert the climate change and ecological and societal disasters which are now fast bearing down on us. And if that sounds negative, you should hear the messages from the people that really do understand these things in detail. And we've shared some of those on through ESGX Live over the last couple of days. I think with that as introduction, I will hand over to Paul Herman to lead us into this week's Green Jobs discussion. Paul.
Thanks, Nigel. Thanks for all your leadership with Earth for All this week, and also with the book launch. So please find the Earth for All book at your bookseller. I've read a preview copy. I'm super excited about the solutions presented and the strategies presented, and learning about a new metric called social tension tied to inequality. So please check out the Earth for All book, and super exciting to have the live streams this week from Climate Week in New York. Amir Khaleghi is with us today from Kansas City in the Midwest, home of the Chiefs, who've already won twice in American football. And so we're going to talk about the Green Jobs Report. It's been a few months since the last Green Jobs Report, so we're going to get caught up on that. We've had the Inflation Reduction Act, so we'll talk about that in the discussion post-Green Jobs Report. And we're going to talk about climate action and how those interact with green jobs or extractive jobs. So super exciting conversation today. This is recorded, so please feel free to share it with friends. If you're watching on YouTube, please hit the like button. If you are watching in regular ESGX, feel free to share the newsletter around. And we have 75 episodes over the course of the past 2.5 years to go back and watch to see how the future has evolved. All right, Amir, it's been 4 months of jobs reports. It's mostly been good news, but there's been rises in interest rates and changes in how everyday people might be looking for jobs. So you want to share the latest on what's going on?
Great. Yes, looking forward to it. So, happy Climate Week for, those of you who are joining us today. Super excited for the discussion that will proceed after the Green Jobs Report. So for those of you who are joining us for the first time, or for those of you who need a refresher, since we have been on a pause for the past 3 months, our Green Jobs Report provides data-driven insights on greening the economy. Our analytics begin with the 7 HIP pillars that have comprehensive metrics on health, wealth, earth, equality, trust, products and services, and management practices for over 2,000 US companies. These US companies are rated based on their performance on these 7 HIP pillars. These companies have a North American industry classification code that is used to be mapped to the Bureau of Labor Statistics industry data. This industry data contains information on the number of jobs within the industry, along with the wages, hours, annual wages, layoffs, and so forth. Based on the information that is connected with the companies that are within an industry, they receive a weighted industry HIP rating. Green industries are bucketed in the 50 to 75 rating score, slightly extractive 25 to 50, while extractive are 0 to 25. For some examples of green industries, you can look at the bullet points: recycling services. Slightly extractive might be insurance agencies, not might be, they are. And extractive industries are those of oil and gas extraction and casinos. For context, this is only a very small subset of the industries that we overview. In total, we look at 190 industries at the 3 to 4 digit NAICS level. So what are our insights? So consistently, we find that not only did green industries recover the fastest from the COVID-19 crisis, they also are the most resilient to job loss. So we can see here that at the peak of the COVID-19 crisis in terms of job reduction, it happened in April 2020. And proportionally, extractive industries suffered a great loss. And even until today, they have not reached their pre-February 2020 level of employment. And we are already around 500,000 above the February 2020 employment level, which is actually a big landmark. It's taken 2 years to reach that employment level, and we finally crossed that threshold in the last in July of 2020. So we can see here that around January marked when green jobs had recovered and began to actually gain past their February 2020 level. And we can see here that, like I said, extractive industries have yet to recover. Something to note is that proportionally, only a small subset of jobs are both green and extractive. Extractive industries constitute around 10% of the employment within our analysis, whereas green jobs constitute around 5%, and the remainder is found within the slightly extractive bucket. As we can see in terms of resiliency, for the unemployment by industry greenness, it's, below the national average by almost 1%. Green industries are, extractive industries are extremely volatile with, we can see along the path, sharp movements across the months, pointing towards more so like a gig economy and being more susceptible to cyclical changes within the business cycle. But as we can see, there was an intersection in July 2020, which may be due to increase in labor force participation, which I can explain in detail at the end of this report. But we can see here that the story of the data shows that green industries have remained the lowest unemployment level and were also the most resilient to the job loss of the COVID-19 crisis and were the fastest to recover. But as we build back, are we building back towards extractive industries? Yes, extractive industries were the slowest to recover, but we would hope for an increased pace and a higher focus in greener industries, especially as we move forward into the future to try to hit our climate goals, especially by 2030. So what has been happening? Well, we can see that everybody felt the pain at the pump in terms of rising gas prices. And over the summer, as gas prices hit a peak of around over $5 per gallon, we saw a sharp decrease in around the May-June time period. And in that, we saw also correlated increase in oil, gas, and mining activities, with an increase of over 34,000 jobs since March, which begs the question, like, are we really building back to a better, more sustainable economy, or are we using band-aid solutions to solve short-term problems that will ultimately cause long-term issues down the road? So, as since March 2020, oil and gas extraction and support activities for mining were actually the fastest growing industries within our analysis. And it's actually reflected when we look at the hipness of the economy. So the hipness of the economy takes a weighted average of all of the companies and industries' HIP score and weights it by employment. And we can see here that in April, we start taking a decline down. The start of the year, we were starting to do an uptick, and as unemployment was lowering, we were seeing a larger gap in between unemployment and actually the increase of the hipness of the economy. But unfortunately, as we increase and start going back to old patterns of extractive jobs, we see the hipness of the economy reducing. Along with the points of resiliency, fastest recovery, green jobs by a very large margin pay better. As we can see here, $46 an hour, equating to, when taking into account the weighted average hourly weekly hours worked for employees within the industry, we have around an 86,000 annual wage, where slightly extractive is 56, whereas extractive is the lowest at an average annual earnings of 50,000. When looking at wage growth as well, with the discussions of inflation and all the, I'm sure the audience is aware of all the discussion of wage growth, competitive negotiations for the employee versus the employer. All industries saw an increase in their hourly wages and estimated annual wages, but green industries did observe the highest proportional increase, especially when we're looking at since January 2010. So a little point on the labor force participation as kind of an economic educational note. You'll notice that in August, the unemployment rate increased to around 3.7%, but we actually increased jobs by 300,000 over the months of July to August. The reason for this is because within the calculation of the unemployment rate, it considers labor force participation. So over the month, we saw a large increase in the amount of individuals participating in the labor force, and those who were entering the job-seeking process were unable to find employment during this time. But this makes sense in terms of the Fed's inflationary responses, in terms of raising interest rates and causing the cost of business to go up, making it harder for companies, businesses alike to expand their operations. Therefore, as more people seek to find employment, businesses might be more reluctant to hire on more workers based on rising interest rates and unable to incur those costs.
And Amir, this is so interesting because the labor force participation rate, you can see on the left, has gone up in late 2021, subsided a little, spiked back up. Um, and so it looks like it's somewhere in the range of like 1/3%. So on 100 million, 1/3% is how much the jobs went up, but there's actually 125 million jobs. So it did go up by about 400,000 or so. Even though jobs are up 300,000, 400,000 more people are looking for jobs. Some of those people are looking for more than one job. Some of those people might be quiet quitting or, silently looking. So do you have an opinion yet about whether unemployment might continue to spike as some businesses are preparing for a recession, or the labor force seems to be coming back? Do you have a point of view on that yet?
I think that it is correlated. I think that as talks of recessions come up, as prices of commodities go up, the price of energy goes up, those who are not participating in the labor force have no other decision than to enter the labor force at this time. So I think from a behavioral standpoint, it makes sense that the labor force's participation is going up, especially with a lot of talks of crises around the corner. As the propensity towards a crisis happening, such as a recession, whatever causes the recession, whether it be a war or an energy crisis or everything in connection with one another. I think as an individual, to protect themselves, they're going to do anything possible to secure their subsistence wage to ensure that they have the necessities in life that they still need. Therefore, I believe that we're going to see a strong uptick in labor force participation over the coming months.
Okay. So it's interesting with the potential recession approaching, the unemployment rate might change pretty dramatically in a short period of time too, if that labor force participation jumps up. Yeah, and then just for those of us with a little gray hair or a little less hair, this is reminiscent of the 1970s, energy crises, regional wars, as well as supply-demand imbalances. So there might be some lessons to learn from that history, but of course, new lessons will emerge, and we didn't have a climate crisis in the 1970s either. So keep going, Amir.
And I think it brings up the point that more people are looking for work, and what type of work are people looking for? And I feel like general public sentiment, people want to do good. People want to hold companies accountable. People want to hold the government accountable and towards transitioning to a just transition, especially in terms of environmental sustainability. And it can be one-to-one in terms of addressing inflation. I think a simplistic view is that if we are increasing jobs, then we're increasing wages, and then we are utility maximizers. Therefore, we're just going to buy everything that is in front of us. I realistically do not think this is the behavior of the majority. I think that the majority or middle class or just the majority in general look to cover their base ends and want to have basic necessities such as education, healthcare, proper energy costs, access to healthy food, just the basic life necessities. So instead of punishing the entire labor market through neoclassical methods of taming inflation, such as deliberately causing a recession based on causing unemployment by raising interest rates, which is the normal protocol by the Fed, we can instead target inflationary pressure points, such as the cost of housing or the cost of transportation, education, or energy. And we can see that if we think back on the Build Back Better Act that was proposed, it tried to address these inflationary pressure points, but due to the political barriers, we were unable to we got a diet version of that might have satisfied a small proportion, it might have been just enough, but almost just too little, in my opinion. And as we see again, it is a different approach with the Inflationary Reduction Act, which aims to, create manufacturing jobs. More than 60 billion is being invested in creating new manufacturing jobs in the hopes to create an infrastructure of clean manufacturing jobs to create an infrastructure. But I think the point is that 60 billion is a grand number, right? But it takes more than just throwing money at a problem for action to happen. And we need collective organization in terms of transition programs. How are community leaders going to get involved and to inspire change at the ground level up and to hold the small subset of industries, companies accountable that are driving these CO2 emissions. And for example, quoting a paper from the IMF, which I want to post.
While you pull that up, let's just take a pause. Nigel, you have some observations on the 1970s as well. What parallels are happening today and what's unique?
I think it's really interesting, Paul. We have this environment exactly where, as you've been saying, there's a huge rise in energy costs, and in some countries this has been really quite extreme. You hear stories from the UK where people now face having to pay literally thousands and thousands of pounds a year for their energy, which might be 5 times what they were paying before. Restaurants closing because they can't begin to afford the energy bill. We're only just beginning to see some of the food chain inflation, which it's creeping through. And as in the 1970s, this is not caused by an explosion of demand. It's mostly caused by supply constraints driven by a war. And the lesson from the 1970s, which Fadhel would, I'm sure, be telling us if he was with us this week, sadly he can't be, is that it was ending the wars in the 1970s and regularizing the entire supply chains, which dealt with inflation. It wasn't addressed by putting interest rates up. Of course, the people that are fan of interest rates will say, look, we put interest rates up and then eventually everything worked out. But actually the driver was the outcome from the war. And I think that's really interesting today. And it's a very tough environment. And there have been some good measures in some countries and not in others. Europe has put in place a massive windfall tax on energy companies who've made huge hyper profits because of this environment. They've done nothing different to make that. And the European governments have said, actually, that shouldn't be your profit. We're going to take it back. And I think that's absolutely right. The UK has done the opposite. They've said, this is absolutely fantastic. You deserve those profits, but the ordinary people shouldn't pay for them. So we're going to pay for them ourselves, and then we're going to get the money back from the ordinary people through taxes anyway. It's a really bizarre policy response in the UK that seems to make no sense. So many lessons from history, but I think a very difficult environment to navigate.
Yeah, and here in France, what has been really interesting for cars that need gasoline, I'm driving a hybrid car that's usually electric when it's local, but on the auto routes needs gasoline to go far and fast. And so Total, which is the French oil company, has applied a discount and cut its margins for gas prices. So both France, the country, has applied subsidies for any petrol that you buy, gasoline at the station. But if you go to a Total station, which is now called Total Energies to include renewables, it's another 10 to 15 cents a liter less. So on a full tank, that's almost 10 euros, depending on how big your tank is. So there are long lines. So again, relative to 1970s of gas lines, when there was gas rationing, you'd see long lines. Today, it's just because there's lower prices. But I did go to at least one Total station that was totally shut down and out of gas. So it's fascinating, the different policy responses. Amir, you looked up a paper from the IMF that tell us which countries it covered. You just put it in the chat so everybody can look in the chat to read the paper. But who was covered and what were some of the lessons from the observations about green jobs and polluting jobs?
So there was about 36 advanced economies. The bulk of the analysis was done on the industries within the United States and Europe, while looking at the occupations in relation to their carbon emission intensity. The summary of the findings really, it was very interesting. It actually found that a smaller subset of workers actually make up the greener jobs, and they label the extractive jobs as polluting jobs. One of their actual findings is in line with our results, is that they found that on average, workers in green intensive jobs earned more, a factor of 7%, in comparison to pollution intensive jobs. And this is on, again, a global scale. I think something to delineate is that their definition of green was only based on carbon emissions. Our definition of green incorporates carbon emissions in terms of products and services, but it's more broad because we look at health outcomes and social positives that are not just environmentally based. So for example, for those of you who have been joining us since the beginning, you might remember Dr. Carolyn McCallahan, who proposed the primary care for all, which again, healthcare, as we know, is a huge inflationary tension point for the United States, and also a burden for not low-income companies, but lower to medium income families. We can see that even from the Inflation Reduction Act or the Build Back Better Act, it tries to target these Medicare expenses. So for example, in the Reduction Act, they're expanding benefits on insulin and capping out-of-pocket drug costs to help those families with illnesses that they have to maintain on a routine basis, so making it easier for to cover those types of healthcare costs. But moving forward with it is that another main conclusion is that the capacity for greener jobs is extreme within industries such as manufacturing, construction. They speak a lot about how do we address geographies that are landlocked in specific types of jobs, and how do we repurpose these jobs to help build out a better green infrastructure. So for example, we might have rural communities in Texas, Oklahoma, the US South that are so intertwined with extractive jobs, right? Oil extraction, but they have skills that can be purposed in a green manner in terms of building out a renewable energy structure. But we have to provide the same incentives and financial benefits, and even perhaps better financial benefits for those individuals in those geographies that have extractive jobs, right? So what does it take to do something like that? Government action is undoubtedly needed. For those of you who are familiar with MNT or the work that is coming out of UMKC and Denison and the Global Institute of Sustainable Prosperity, we have been huge advocates for the job guarantee program that can be used at a in collaboration with trade unions, like unions, whatever it may be. But we need programs in place that can help repurpose individuals and their occupations to have a collective effort in building out the infrastructure for more sustainable energy sources. And without that, the decentralization of all of these actors, it causes friction in terms of the pace at which we can move towards these solutions. And we are not in a place that we can move slowly. Truthfully, we're not in a place that can move slowly. Every one of us can feel the impact of, the changing of the climate and tangible differences of not even 5 years ago or 10 years ago. So this is a serious issue, and we need government backing to support the actual majority thought in terms of being in favor of transitioning and being at a point where we're at a fork in the road to decide the next 50 years, the next 100 years of not to be dramatic, but like humanity itself. Like truthfully, we're at a point in that. And sometimes as we go through this green jobs report, we're harping on the same things, but you can hear our tones. We care about this. And those of you who are watching, I know that you also care about this too. And we are truthfully in a time period where we have to act and hold that small subset of industries and I don't hold the workers accountable, right? Because I doubt a large proportion of people are saying, I want to pollute, or, I want to cause this ongoing catastrophe. It's more complicated than that, because sometimes a person might be inclined into supporting an extractive industry because it's providing them a wage that's supporting their family and their livelihood. So what we need to do is just replace and still support people's livelihood, but be more productive in the product and service that they are providing.
Super
I'll just,
Amir. Sorry, go ahead, Nigel.
And so just add to that, the point you've made about how important this is. Paul mentioned right up front that the Earth for All work has a social tension in it, social tension index. And one of the most striking things from the projections is how much that increases if we continue we're on the current path. And we've already seen the beginnings of that in the standard of living for many people in rich nations has already begun to decline. There's more media in the last few days about how the UK has a small number of rich people, but has a larger and larger number of people who have a relatively tough life. The US is even more extreme. And the point is that environment where there is growing social tension, where there is growing inequality, is one which is a fertile ground for authoritarian leaders. And if those are the bad kind of authoritarian leaders, if I can put it that way, that is how democracy falls apart, and falls apart really quickly. And those threats are now very real. And we've seen different versions of it in various different countries.
And truthfully, I believe that there's a tangible disconnect between the wealthiest 1%, 5%, whatever it may be, in terms of the drivers and incentives for the rest of society itself. I don't know. It's extremely important. You can hear it from my voice. Like, I look outside and you see all these changes, and those around you just suffering at the cost of higher prices, but not even that. You see the changes in weather patterns and whatnot. And it is truthfully, a time to act. And I know that many, you speak about this with any person, perhaps on the street, at a restaurant, or at a conference. There's not many in disagreement. So who is in disagreement? The large, corporate powers that have incentive to invest in infrastructure and oil and gas and mining. It's already spending trillions, even to this day, to ensure that this industry lives on. But there's this huge disconnect and juxtaposition, because what is the point of attaining all of these profits or continuing to invest in this if 20 years a crisis becomes so large that the East Coast is underwater? It doesn't matter at that point. So truthfully, as a society, we have to make the change and the objective decision we have to hold each other accountable and move towards a positive solution, or it's this prisoner's dilemma that everybody loses, sort of thing. We're in this weird, very weird game theory social experiment, to this day. So
I'll just make a quick announcement here. It appears that the chat may not be showing up for attendees. So I have put the links to the paper that Amir referenced about the green job market in developed economies, and a link to the living wage tracker from MIT. I put those in the YouTube chat. So if you go to ESGX on YouTube, you'll see those links. If you don't see them in the chat, Zoom chat here, apologize for that. Okay, so let's start to wrap up. Amir, any other conclusions you want to bring together?
It'll be interesting to see how the next quarter plays out in terms of the Inflationary Reduction Act. I truthfully want to side for the optimism that general need and call to action between general populations is increasing. So I hope that we can centralize as a society in a decentralized fashion to work towards these goals. Quickly though, I am noticing a question from the audience of how have high hip green companies performed in terms of profits in the last year? Paul, would you like to answer this one? I know that I'll let you decide on this one if you feel.
Yeah, happy to. Yeah, so there's two ways to look at this. One is, what is the shareholder return to companies that have a higher HIP rating, which over time generally have done better because they manage risks in a more proactive way. And then investing in sustainability can be a high return on investment approach. So both from lower risk and lower cash flow volatility and typical increases in investing in people, investing in energy efficiency, investing in renewable energy as a company to make yourself more efficient, as well as not being sued by not abusing stakeholders. That is generally good for a portfolio. In companies, there's different approaches. One of the to cash flow and reinvestment. One of those is CEO pay. So HIP has a ongoing partnership with As You Sow, a nonprofit. And for the past 8 years, and this year will be the 9th year, what we've shown is companies with overpaid CEOs typically underperform financially. So I think what you'll find is, in general, not 100% absolute, but on average, investing in people is generally a positive return on investment. Investing in planetary efficiency, energy, water, waste reduction, emissions reduction generally is a positive ROI, and those accrete to the bottom line. So thanks for that question. And there's more information on the HIP website, and there's several hundred academic research papers that show similar conclusions.
So as a wrapping up note, you can come to expect in the next report or the one after the next report, a Green Jobs 2.0. The main methodology changes. Right now, we're doing a straight average over industries. We're actually going to look at the proportionality of greenness between industries. So let's say the oil or like chemical manufacturing. Chemical manufacturing also includes pharmaceuticals that are used to cure disease, but also includes industries that make plastics or rubbers or extractive inorganic materials. So we will be taking a cut and we're going up a level of granularity to uniformly look at the 3-digit NAICS level and look at the proportionality of greenness based on the company employment count. What this will do for us advantageously is we'll be able to look at geographic BLS data, so by state and metropolitan statistic area. And by doing this, we can actually take a deep dive in seeing how the South, East, West, North, how do they compare to one another in terms of their proportionality of green employment? So we're super excited. This is kind of ushering in a new segment of analysis, and we're continually excited to bring you the reports, but we can't be only just bringing reports. We also have to do action. So I encourage everybody, to do what they can, and we'll be here to report about it.
Thanks, Amir. And you'll be finishing your PhD in the coming year as well. So we're super excited about that at University of Missouri, Kansas City. And so appreciate all your leadership on this, your deep dive on green job analytics, and finding additional research about how that's playing out around the world. So super insightful. All right, well, as we start to wrap up ESGX for this episode, our 75th episode, you can see all 75 episodes on esgx.org and on the YouTube channel, so feel free to like and share. That'll help more people access the information. That would be fantastic. Nigel, you have a video for us before we wrap up?
I do. Just a couple of quick words. We have a paper we've just put out, which is a high-level summary of everything in the Earth for All book, and picks up on the words from one of the introductions talking about this meta-crisis, which Amir has explained so well today, which is these different threats to us environmentally and with climate change and ecologically through degradation from the farming, food supply chains, etc., and the implications for society. We have as a bit of exciting news on Friday, which is at the end of Climate Week in New York. It is also Climate Strike Day. We are going to be ringing the bell on climate change with a closing bell at the New York Stock Exchange, just with the Earth for All project, which is really quite cool. So we hope to bring a live stream from there, and we hope you will see this logo plastered all over the place. And what I will do now, just as a way to wrap up, will be to play a quick video, which is a really good explainer of what is Earth for all about. So thank you very much for joining us. We'll be in touch with future episodes very shortly.